Welcome to the April 2025 Real Estate Market Update brought to you by the Reby Homes team. Let's start our national update with this quote from the Groundwork Collective. What you need to keep an economy chugging is businesses investing, businesses hiring, and people spending money. If people are apprehensive about whether their jobs are going to go away or whether there are going to be more layoffs in the future, you're going to start to see a pullback on spending. Of course, consumer spending has an impact on housing, along with inflation, unemployment, interest rates, and more. And since March of 2023, consumer spending has gradually but consistently climbed until January of this year, that is. This January was the first time in 2 years that consumer spending dropped off a little. A lot of people think that this could be a big recession indicator, including Mark Zandi with Moody's Analytics, who says this: I'm raising my odds that a recession will begin sometime this year to 40%, up from 15% at the start of the year. Last week's economic data were disconcerting, including the slide in consumer confidence, punk consumer spending, and persistently high inflation. Not to mention, people are definitely uncertain about tariffs. And all of these concerns, coupled with headlines like these, are widely shaping consumer perception of the housing market, despite some of the information being a little misleading. For example, Patrick Bet David posted this graph showing 6.1 million Americans are behind on their mortgage payment. But if you look closer, that's relative to multifamily homes. This is just one example, but the point of headlines like these is to drive attention to them in order to sell a narrative or more advertising. Most of the time, the article itself contradicts the clickbait headline. So just a reminder to take what you hear or read with a grain of salt when it comes to mass media, especially if it's national news. Real estate markets are vastly different city to city, not to mention state to state or coast to coast. So the best thing to do is stay updated on your local market, as that's what directly impacts you. There's a lot of talk about a recession right now, but it's important to note that a recession does not equal home prices falling. And one of the strongest economic factors in this economy right now is homeowners. Homeowners, on average, across the country have over $311,000 in equity. So the connection between a possible recession and a housing crash just isn't justifiable at this point in time. What does typically fall during a recession, however, is mortgage rates. Going back to 1980, across the last 6 recessions, mortgage rates have dropped every single time. Inventory is up significantly in majority of the markets, which is great for buyers as they now have more options. We're approaching pre-pandemic levels in the South and the West, and some people are sounding alarm bells that we're heading towards an oversupply. So let's take a look at where inventory is expected to go. This graph shows seasonal trends for inventory going back to 2017. The dotted yellow line is where we are now, which is right on trend with historic norms. If we continue on this trend, then we can expect to see inventory gradually increase throughout the summer and fall, and then drop off at the end of the year. Until we see any large changes with mortgage rates, here's what we can expect for the remainder of the year. Home prices will remain stable or very subtly increase as they have over the last 3 years. Days on market will likely increase as homes are taking longer to sell, and inventory will likely continue to climb as well, giving buyers more options. And now let's take a look at our local market here in the Phoenix metro area. Inventory is a big topic right now as it continues to increase to levels that we haven't seen in over a decade. We're currently at just under 30,000 active listings, which is up 4% from last month, 30% from this time last year, and 45% from 2023. This is significant because it gives buyers some major breathing room, which they desperately needed. With more homes on the market, they have more options and a lot more power in terms of negotiating. Not to mention, it puts some relief on prices. Buyers are looking for the best home and the best price. So if you're a soon to be seller, prepare to invest in the condition of your home to up the appeal or be prepared to discount the price significantly. Homes are taking longer to sell, and the ones that are going are either the best home in the best neighborhood, priced well, or it's priced strong enough for buyers to bite. Nonetheless, homes are still selling. Sales volume is up with just under 7,000 sales in the last 30 days. That's up month over month and year over year by about 550 closings. As mentioned, homes are taking longer to sell, so it's no surprise that days on market for active listings is up year over year, going from 78 days this time last year to 85, which is right on par with last month. Because of the increase in inventory and no change in rates to entice buyers, prices have eased. Average price per square foot is down about 6% from last month, going from $316 a square foot to $300 a square foot, which is exactly where we were this time last year. So flat appreciation year over year on average. Keep in mind, this is an average across the Phoenix metro area, so different areas might see slightly different markets. For example, this is a heat map. This shows market trends in each area of the valley. The yellow and orange colored areas are considered warm or hotter markets, while the green is balanced and blue is cold. We can see that overall, majority of our markets right now are balanced, but leaning towards a buyer's market. The way this map is broken down is by zip code, and the color is based on the ratio of active listings to homes under contract within that zip code. So if we zoom into the two yellow and orange areas between Phoenix and Goodyear, which is the Tolleson area, we can see that 85353 has 91 active listings, but 64 of them are under contract, whereas Phoenix 85016 has 68 under contract, but has 241 active listings. But if we look at just single family homes, we get a few more markets like Tempe, Mesa, Gilbert, and Chandler that start to warm up a bit. And if we take it a step further and adjust for homes under 500,000, then we can see even more warmth in Scottsdale, parts of Phoenix, Tempe, Gilbert, Chandler, and Carefree. And here's a closer look at the Chandler Gilbert area and the under 500,000 price point. This market has some warmer spots. And of course, at this price, Scottsdale and Phoenix are warm. However, that's because there really isn't a whole lot of inventory at that price point. So when they do pop up, they go quick. But if we up the price point to $1 million or under, which is more realistic for Scottsdale, it gets much cooler. So that's a pretty big indication that the market, even the hotter markets, are starting to slow down. These maps are helpful to see how markets can differ from one to another, despite only being a few miles apart. And a quick look at closings over list price, which seem to be trending along with 2023 and 2024 numbers. Last month, 638 listings closed above list price, which is roughly 16% of all closings, and the average amount above list was $5,000. And of course, many of the homes that are closing above list are oftentimes giving concessions in return. Here's a look at seller paid closing costs. March ended with 52% of all closings having some sort of credit from the seller, on average about $10,000. In many cases, the buyers that offer $5,000 above list price are likely asking for $10,000 in concessions. They do this because the $10,000 can have a significant impact on their payment, and the seller feels like they're only compromising $5,000. And here's a look at weekly price changes, which right now is mostly price reductions. This graph goes back to 2015, so we can see where we are now, which is much higher than historic averages, but lower than the bottom of the market that we hit back in 2022. We can expect to see this trend continue as inventory grows and rates remain unchanged. This is a good place to remind you that when things do change, however, they can change fast. By the time we realize prices have hit the bottom, which is what a lot of people are waiting for, it'll be too late. The best thing to do is keep up with the data monthly and make a decision when the time and circumstances are right for you. And let's wrap things up with foreclosures and rentals. This graph shows homeowners that are in pre-foreclosure, and keep in mind many of them have enough equity to avoid going to foreclosure. Nonetheless, it's a great representation of where things are. The far left side of this graph starts in 2006. That peak we can see is March 2009 in the midst of the crash, where there were over 10,500 homeowners in pre-foreclosure. Today, there are 494. Many national headlines like to point out how this is up significantly from 2019 to 2022, which is true, but that's because those years had forbearance programs that kept a lot of these people out of trouble during the pandemic. So although it is up from that time, it is significantly lower than historic norms. And last is rentals. No major updates here. Rent prices have fluctuated between $1.35 a square foot and $1.40 a square foot since August of 2021. Seasonal trends remain apparent, with November, December, and January being the lowest rent prices, and May, June, and July being the highest. So if you're looking to rent or list your home for rent, pay attention to those trends. The biggest takeaway from this month's market update is downward pressure on prices is strengthening. So sellers, be prepared to list strategically, reduce the price when necessary, and improve the condition of your home before listing. And buyers, this is your opportunity to get a great deal. Concessions from sellers can mean drastic improvements for your monthly payment and out-of-pocket costs. This is definitely a market to take advantage of if you can. And that'll wrap up our April 2025 real estate market update. Thanks so much for tuning in, and we'll see you next month.